This is the Alternative Investing Advantage podcast from Advanta IRA, where we show you how to explore investments beyond Wall Street and open your eyes to new options for your portfolio. It's time to take control and give yourself the freedom to choose where you invest your money.
Hi, and welcome to another edition of the Alternative Investing Advantage podcast. My name is Alex Perny, and today we are pleased to welcome on Micah Fraim, and we're going to be discussing some really interesting topics on cryptocurrency and taxes, so stick around for that. But today on the download, Goldman Sachs has announced that they will be shuttering their consumer lending arm as new loan origination drops along with the rise in cash home purchases. Definitely something to watch out for as people are starting to retreat from the traditional lending market and starting to look more towards cash. This also comes on the news that U.S. housing prices cool even further through the beginning of 2023, down 2.7% from their peak in 2022. I think this is going to be a continual slide that we're going to see as the monetary policies that Jerome Powell has put in place to continue to rise interest rates through what is indicated through May of this year to start cooling inflation and to hopefully start bringing some pricing back in line with what the market can actually bear, but definitely something to watch out for. And today, to round out the top news in finance, Tesla has announced plans to build a northern Mexico plant on a recent earnings call with Elon Musk. So definitely exciting that they're going to be bringing in some North American manufacturing, granted not in the United States, but keeping the manufacturing of auto parts and cars within North America is certainly going to help alleviate some of the burden that people look at when it comes to purchasing new vehicles, and also with the technology drive for electric vehicles that Tesla is actually putting out into the marketplace by selling other components to manufacturers such as GM and Ford and Chrysler. We're also going to see the reduction in price of some of those other electronic vehicle components by having additional manufacturing capacity from Tesla in North America. This has been The Download. Today on The Download, what is Section 230 protection? It's important to understand this with current legislation starting to strip back liability protections for internet service providers and other content creators on the internet to understand what Section 230 is. Section 230 is a provision of federal law that protects internet web hosts and users from legal liability for online information provided by third parties. In addition, the law protects web hosts from liability for voluntarily and in good faith editing or restricting access to objectionable material, even if material is constitutionally protected. Section 230 was enacted as part of the Communication Decency Act of 1966, which amended the Communications Acts of 1934 U.S. Congress. The provision was intended to promote the development of the internet and interactive computer services to expand information and educational resources available to the public. This has been What is Section 230 on the What Is. Hi, and welcome to another edition of the Alternative Investing Advantage podcast. Today, we're going to be diving into about the most alternative of alternatives in cryptocurrency and taxation issues. So buckle up. It's going to be a fun one. We have Micah Fraim with Fraim Cawley, a CPA firm that specializes in cryptocurrency taxation issues. And there have been quite a few updates, at least over the past 4 years, and how these things are considered from a taxing standpoint. And of course, I like to always frame this with the benefits of doing these kind of things through a qualified plan like an IRA can make your life a lot easier, but that may not always be feasible. And a holistic and well-rounded understanding of the rather garrulous nature of taxes and cryptocurrency is very important. So Mike, I really do appreciate you being on with us today.
Yeah, thanks for having me, man. Always enjoy doing these.
Absolutely. So give us a little bit of background about yourself, kind of how you came to rest in the niche of taxation and crypto, and a little bit about your firm as well.
Yeah. So we've been in practice about 10 years. I always say I'm more of a business person than an accountant, and I get bored really, really easily. So after we established and had enough to eat, I really started working with online businesses or growth-centric companies, stuff where the situation was rapidly evolving and changing. Because even though I love my clients who had the same situation for the past 30 years, there's not a whole lot of planning to do with that. There's a finite amount of value I can provide. So we've been dealing mostly with that, a little more tech-centric clients anyway. And then, like everyone else, bought a little bit of crypto in 2017 during the ICO craze. My money quickly got cut in to a third of what it was within about a month. Just parked it, forgot about it. Then 2020, a client came to me and they were involved in a node project, and it was I always say it was the first time I understood the utility of and use case of a specific crypto, because before I'd heard, okay, blockchain's a big deal. People say that's a huge deal, but so much of the tech is open source. Like, why does Bitcoin versus Litecoin versus any of like the three that I knew at that time, why am I going to buy those? So anyway, got into that. From there, that was sort of like the red pill of like being, opening my eyes a little bit, getting more interested. And then I just kept digging more and more into the space and messing around with it. And kind of ended up on the tax side on accident. It was largely because we were trying to plan for ourselves and for the clients we had, and realized there's no guidance out there, or next to no guidance. I should qualify that. It's very, very limited guidance.
Yeah, absolutely. Now let's kind of maybe start this back in, your beginning, because the landscape, with the limited guidance we do have, kind of came about in the 17-18 run up with all the ICOs and people starting to get really, big exposure to what cryptocurrency was. I mean, you had the first big real run up of Bitcoin. I mean, I think the peak of 17, it was what, like 28 change?
So, somewhere in the 20s. I can't remember exactly, but yeah.
That was like the first big run up. And obviously we've seen it run up to, 69-ish last year. But, it's the first real big run up. And, obviously this gets the attention of the IRS. And, previous to that, the taxation was, it was considered, they had given some guidance of stating, this is considered, was it personal property?
They just said they said property. They qualified that it was not a security. They said it's property for U.S. income tax purposes.
Yeah, and then they also got away with like-kind exchanges of that, having to consider all these as individual tax lots for reporting of, gains and losses. Now, maybe, my definition is probably not as maybe drilled down as to what, a tax lot means. Maybe you can explain that a little bit of how this applies, because when people think of tax lots, they're going to normally just think, oh, I see that on like my, fidelity statement or something. What exactly does that mean, and how does that apply in this scenario?
Yeah, so the IRS, largely because of the ICO craze, they were doing the Tax Cuts and Jobs Act, the 2018 tax reform right around then. And we also in 2018, similar to what we had in 2021 and 2022, had a big bull run and then a big bear run. So you knew people were going to try to be able to just say, well, none of those were taxable events. I was just doing, I was just like kind of exchanging a whole bunch of different tokens. And the IRS or not the IRS, but Congress in that legislation said very specifically that 1031 like kind exchanges are exclusively for tangible property. Intangible assets like crypto don't qualify. And they also, it's kind of interesting because when you look at some of the other guidance they've given, because I think a couple of years later in 2019, I want to say, people were asking, okay, well, 2018 and forward, obviously I can't do like kind exchanges because of the fact that this legislation's passed. But what about 2017 and prior? And the IRS did a revenue ruling that did some analysis on Bitcoin, Ethereum, and again Litecoin, because they're like 5 years behind on what the big players are in the space. And they examined the utility and the use case and why people are investing, and said even though they're all cryptocurrencies, they're not like kind enough to avoid those taxable events. And that's kind of the way they've always treated it. They do the same thing with precious metals. Gold and silver, they've had guidance before, and I think even court cases where they've said the reason you hold gold, even if they're precious metals, the reason you buy gold is different than why you buy silver. So with that, they make it to where every single trade, long-winded answer, every single trade you have a token for a different token is its own taxable event.
Yeah. So to kind of, flesh that down a little further. So essentially what you're saying is that, if you bought, Bitcoin for 10,000 and you exchanged Bitcoin at a price of 15,000 for, $15,000 worth of Ethereum, you had a $5,000 gain that you have to track. Conversely, if it went down in value, you'd have a $5,000 loss that you need to carry and make sure you offset, your, end of year, January 1, seeing what your ledger of, your total P&L statement is going to read, right?
Yeah, absolutely. And people don't do that. And especially crypto enthusiasts have no desire to cash out. So they'll keep trading and generating all these taxable gains, taxable losses, and just ignore it because they think until they cash out for fiat, there's no tax due, which just isn't the case. The IRS has very specifically said that's not the case, and every one of these coin for coin trades is taxable. So
and they also brought up, as of last year, you had to declare when you're filing your 1040 that if you had any investments in cryptocurrency.
Yeah, I think it's been 2 years now. I could be wrong. I think it came around in 2020, but it's been a couple of years now that you've got to check. You have to, like, right on the first page, like under penalty of perjury, you've got to attest to it on every single 1040, whether or not you had any crypto activity, basically.
Yeah, exactly. And I think what people need to realize is that, so much of the market with this is, it's kind of very insular. You get into the cryptocurrency space and, there's this whole ecosystem where they're trying to build a new world, but they have to realize it's still on the same planet that the IRS lives on. It's maybe not so much of a different planet, but it's, maybe an island or, it's still under the statehood of what, you have to consider with this. And I think people get into a lot of trouble in thinking that, oh, well, I'm doing all of this, I'm trading this X, Y, and Z. And since they're not actually seeing like dollars in their Chase checking account, they're under the misconception that saying, hey, I don't have a potential tax issue here, when you absolutely do. So when it comes to that, and especially with the volume that a lot of people like to trade in, it can really become a nightmare for having to track all these individual tax lots of what, your gains and losses are, and things like that. Now, has there been any other guidance as to how long you can carry forward losses? Do these all have to be claimed within the year that they were derived, or is there kind of some cross pollination to other tax law or ability to have losses carried in the cryptocurrency space?
Yeah, well, I mean, cryptocurrency, you're going to report that the same as you would. It's not a security for tax purposes, but you're going to report the income pretty much the same way you would on Schedule D of your 1040, showing capital gains and capital losses. So that's the bucket that it falls into. So capital losses, you're able to use up to $3,000 a year to offset against ordinary income. And then if you don't have that just carries forward indefinitely. Those losses don't expire. So you can use those either against future crypto gains, $3,000 at a time, or against other capital gains that you have from stocks, from selling a piece of property, something like that. So that's one of the things we've been doing a lot this year is people haven't been wanting to tax loss harvest quite the way they should because they're like, well, I don't have any gains to offset against it. And it's especially depending on the mix of your portfolio, it can be a little bit of a pain to execute all those trades on the 20 different platforms you're on. And there's not a huge immediate tax benefit when you're in a bear market and you don't have other gains. But if you extrapolate that over the next 5-10 years, when you almost inevitably will have gains, the tax savings are pretty significant.
Great. So from that perspective, now short-term capital gains are considered ordinary income, correct? Or am I mistaken?
Yes.
Yeah. So
yes.
Anything traded, within 365 days is considered that is considered short-term capital as an ordinary income, correct? It's a year and a day for long-term.
Yeah.
Okay. Okay. So for anyone, and I think that kind of goes to show, I mean, that is a small minority of people that are probably holding for a year and a day on any cryptocurrency. I would stake a good amount of money on that statement right there. I don't like to talk indefinites, but you asked 9 out of 10 people, and I think 9.9 of those people are stating something like that. So, with that said, you have the indefinite carry of the losses. Now you can only offset $3,000 of gains for a typical cryptocurrency investor. But like you said, you can use those losses potentially to cover other capital gains that you might have, correct? It doesn't have to be
absolutely, 100%.
Okay,
and that's depending on for the clients we have who are just deep in crypto or just in crypto and stocks, and it's not stocks they've held for 10 years or something. For them, the tax loss harvesting, if that's all they have, we're not seeing a lot of current year benefit. We've got clients who have a decent amount of crypto and a ton of real estate and a ton of other capital assets that we're able to utilize in real time, those crypto losses that we're harvesting.
Yeah, no, that seems kind of like something that I don't really hear a lot of people talking about, is the ability to have, with how volatile the market is, of having, being able to show losses in a particular market, with something that does still have potential upside to. And again, I'm not exactly sure on the terminology of loss harvesting. I'd let you, kind of extrapolate on that, but especially for people like real estate investors, that's pretty interesting. Maybe if you're invested in something outside of like a a 5-year depreciation window, if they're doing accelerated and cost seg and they pass through, let's say in a limited partnership, they're passing through all that in 5 years. And especially with this market right now, I'm seeing a lot of people in the commercial real estate business, kind of adjust their offering documents to not just be, previously, that it was like a 4 to 5 year window. They're trying to capture all of that depreciation, pay out everything, and then turn around and refi or sell out the property. And that rinse, wash, and repeat method I've seen work pretty well over the past, probably about 7 years or so.
Right.
It's pretty easy to make that work. But now with the like huge squeeze on cap rates for a lot of these deals, especially in the commercial real estate market, having a tool where you can start to create, have these losses occur to help offset some of that income that's coming in, could be a good thing, especially from that perspective.
It could be. It's a little bit harder in the buy and hold scenario for real estate, just because, and again, this is what gets maddening with taxes, but rental income is in a category of passive activity losses for the vast majority of people, which doesn't directly offset against the capital gains. When you sell the real estate, if you're doing a buy and flip, then we can use them. But there's always some little weird caveat to this stuff.
Would that still apply to a limited partnership that's paying out on K1 for revenues generated by the underlying asset?
Typically, yeah, because the K1 is going to classify it as a rental loss.
Correct. Yeah, because they have that whole like drop down of everything that you declare.
Yeah. So typically those are in two buckets, same as ordinary income, and that's what gets interesting with the tax planning. And what most people are doing are just buying and trading in crypto, but we have the same issue when we're talking about certain types of crypto income or business income, like nodes, mining, occasionally a play to earn game, and all these things. It's kind of, you got to look at the bucket it falls into, and that's one of the, we don't hear much about them anymore. But I think back in maybe 2020, 2021, those really high interest DAOs were all the rage. Like you had Wonderland Time and these things that would pay like 80,000% interest a year, just something like absurd.
Yeah.
And what you would have is because that's so inflationary, the token price would just very predictably collapse. But you could have it to where people would be earning all this interest income in one bucket and then have this huge loss on their token, but those aren't directly offsetting on your tax return. You can have it to where you've got a bunch of phantom interest income and a capital loss if you sell the token, but you don't get to directly hit those two against each other. So we've had people where theoretically you could have like $100,000 of realized capital loss and $100,000 of phantom interest income from this project, but you're still paying tax on 97,000 of it because you can only use the $3,000 loss.
Right, because that income. So yeah, because the interest income is going to be calculated on your ordinary income side of things, not on a capital gain. Now, would that change if you held the asset that was paying interest for more than a year, or no? Because that would seem to me kind of like something like a, same thing as like, the interest paid on like a, money market or something like that would be similar to that kind of thing.
Yeah, but it does. I mean, interest is always ordinary income. The only time we get around that is if you have a security and you're getting a dividend, which, even though, especially staking income and a lot of these interest payments are effectively dividends, but that's not the way they're classified. You don't get those long-term or those qualified dividends
because it's not classified as a security, right?
Yeah. And that's
So,
what's going to be fascinating, because the SEC and parts of the IRS want at least some of these to be securities. So exactly how they figure that out is going to be kind of fascinating.
and I think that, and I think it's really been illustrated by, things like Celsius and FTX, is that, I get it. The need for something more decentralized and a new way of thinking about finance was needed, a fresh set of eyes on it, a new system. But at the same time, it opens it up for, bad actors to really just screw with people, with very little oversight. And because this stuff is inherently complicated, and I think it's complicated because the people that do this enjoy a level of complexity that I don't think necessarily needs to be there. This stuff could be way simpler, but the people that write it and the people that do it, enjoy that kind of, oh, I did this and X, Y, like, they're just those kind of people, which,
that's how a lot of accountants are too.
So, I think that, with that, there's probably going to be some good and the bad with it. Anytime the government gets more involved in something, inevitably it gets, constricted, more regulation, more red tape. But at the same time, if they do come in and start classifying these as securities, I mean, I think what you're saying is that it may open up a lot of additional tax planning opportunities for people, because otherwise they're, the nature of this really doesn't lead itself to long-term capital gains. Whereas with, or I should say the income maybe of things like staking, or if you have some type of, some type of benefit to being involved in a certain project, then, that may very well, open up the doors for some additional, tax benefit to people. Now,
yeah.
So go ahead.
No, exactly. And there's going to be, as regulation comes, not only do you have just I've always said, I think some regulation is absolutely needed, as we saw with especially FTX, but all of these exchange failures. I think given especially FTX, the regulation we get is probably going to be a little bit overboard, but we definitely need something. But yeah, with regulation, and if they are classified securities, you're going to have the downside of, and I don't even know if this maneuver was going to survive anyway, but right now crypto isn't subject to what they call the wash sale rule, which for a traditional security, if you sell it for a loss, you're not allowed to buy it back for 30 plus 1 day. So 31 days. Otherwise, the IRS says, hey, you didn't really sell this asset. You just sold it and bought it right back to generate a loss on paper. So they disallow the loss. Crypto right now, at least, isn't subject to that. So if you bought Bitcoin at 60K and sold it at 20, you can sell it right now and buy it right back and realize a $40,000 loss. So if it gets classified as a security, that's going away, even though it's probably going away anyway. They've had some proposals to close the loophole, and they haven't gained traction. But at the same time, if it's a security and you're getting staking income, it becomes much more justifiable that staking income is a dividend, and if you hold it for more than a year, you should get qualified dividend tax rates on it.
No, absolutely. Now, again, I understand it, but maybe from your perspective, define for people what exactly staking means.
Yeah, so staking, and again, I always say I understand from the tech side. I understand the 101. I'm not a tech expert, but typically the new protocols, like the old Bitcoin, Ethereum, up until a couple months ago, were proof of work, where you had these miners that were sitting there just cranking out algorithm, burning all this electricity to solve these calculations. Proof of stake, a big reason, is more or less like a delegation, and you're using your tokens and staking staking them with a node validator, sort of like you're voting for them. And if they get enough votes, when the block on the next block completes, they get a certain amount of tokens, and most of those will go to the people who voted for them. So it's kind of like you're electing a board member, and for that, they get some money, and then it's not even a great example electing a board member because they wouldn't receive the money and then shoot it off to you. But effectively, that's what you're doing. So as a reward for voting on the people who are sort of running the network and who are ultimately making a lot of the decisions, since you're voting for them, you get a certain percentage of the rewards that are being generated on the blockchain.
Gotcha. So as far as like current issues, what are some things that are really cropping up for people right now that are of particular interest besides, again, like the issues of just the market in general with people like Celsius and Voyager, and the issues with things like Stellar and FTX, besides all just like, let's just say less than good intentioned people in the operations of these markets, that's hard for people to avoid. It's, how do you avoid a Bernie Madoff? How do you avoid Sam Bankman-Fried? How do you avoid these people? Well, it's tough because before there's issue, before like the, house of cards crumbles, it looks fine. And that's the issue with fraudsters. So, besides that, what are some real issues in the market that you're seeing that you think people can maybe either change best practices or things to look out for, at least from your professional perspective on issues that are arising right now?
The biggest one is one of the easiest ones to correct, and it's not something that maybe not so much 2022 specifically, but especially hopefully 2023, because we've been in such a bear market. We're hopefully going to have some degree of a bull run, and maybe not this year. In the nearish future, we're going to have another bull run more than likely. And what we ran into a bunch last year wasn't 2022 tax issues. It was people who hadn't done any planning for 2021. So we would have people who came to us who had 7 figures worth of realized taxable income in 2021 because they were doing a bunch of trading, they were getting staking income. It wasn't like they were just hodling and they just had a token that was doing great and they didn't sell it. These were all taxable events for the year, but they kept just rolling it back into the market. So we've had, and then the projects tanked. We've had people where they had $1 million plus of taxable gains, but after the market crashed, they only had like a portfolio around 50 to 100 grand is what it was worth. And because they had $1 million of taxable income, they had a $400,000-$500,000 tax bill, and their portfolio is worth a tenth of that now. So that's one of the things that when we have the next bull run, people need to be really careful of. And it sounds super basic, but if you're having realized true taxable events, you've got to cash out at least enough to pay for the tax bill. And crypto guys won't want to do that because it's only going to go up. Money printing machine go burr. Like it's all that it only goes up. And so they don't want to lose the upside. But worst case, you cash out 30 to 40% of it, set it aside, and the market goes up and you lost a little bit more upside. That's a lot better than the scenarios that we're seeing with these people who have 6-figure tax bills and literally no way to pay them because they don't have the assets don't exist anymore. So we have to hammer people a lot, not only to cash out as they go, but also please put it in an FDIC insured bank account. Don't put it in a stable coin, because you're either going to put it in UST and Luna collapses, or you put in USDC and Voyager, Celsius, FTX collapse, and you can't get it out.
Yeah, and also just the inherent issues with those stable coins. And I covered this on a podcast, earlier last year, of understanding how cryptocurrency markets work is very similar to how, U.S. securities market work. There has to be an underlying liquidity standard in the U.S. That's the U.S. dollar. That's what actually exchanges when you hit buy and sell. There is an exchange. It's balanced daily, but there's huge amounts of wire transactions going out that are the liquidity standard that are making these markets run. And how does that work in the cryptocurrency markets? Well, they have stable coins, things like Tether or UST that are broadly adopted. And there's an assumption that these are always going to remain at a certain value, which is typically 1-to-1 to US dollars. But we've seen them, what's happening is they're depegging, meaning that they're losing value against the US dollar. So your trade for 1 Bitcoin is now going to be a shortfall. So your bid ask is going to get all messed up. And the markets can't function. So I think what you're saying is very good practice on that. Yes, the appeal of cryptocurrency is, the decentralized nature of it, having a new type of financial market to be involved in. But understand there's a real big value to the bread and butter traditional, US system of FDIC insurance on your deposits, having the US dollar, which is the global standard for trade. Like that, like when you buy something like in Malaysia and you want to sell it to a Mexican, let's say factory, the way they work that is that they take the Malaysian dollars, they convert them to US and then convert them again into Mexican pesos. Like that's how international trade generally functions. It's cumbersome, yes, and cryptocurrency can hopefully solve some of that. My dad made a joke. He used to do a lot of traveling in Southeast Asia. He goes, to do business and trade deals over there, it'd honestly be quicker to fill duffel bags full of money, get on a plane from Florida, fly to Asia to do the deal than it is to wait for money to change across borders. And I think cryptocurrency hopefully can aim to solve some of that. But again, like you said, you have the ability to create huge tax bills. And because of the way this works and them being short-term capital gains, if your loss can only carry $3,000, telling the IRS saying, hey, can I get a payment plan?
Right.
Is really your only option, and hoping that they give you something that you can even afford at that point. Because if your portfolio goes, 90% down, you had $1 million worth of, realized income in that year, and you can only offset 3 of it. That's still a big tax bill to have to split up over 5-7 years.
Well, it's a huge tax bill, and anything over 50 grand for a payment plan, the IRS has to approve. And when you submit that application for an installment agreement over $50,000, they're going to ask you for basically a liquidity statement and say, give us a balance sheet, show us what all your assets are, what all your debts are. We want to look at your income. They're looking at you like any other creditor. And so if you get it, it's huge. There's a good chance they're going to be like, look at that and say, hey, we're only going to approve you for, you have a $300,000 tax bill. We'll approve you for 150, but you need to sell this crypto that you have on there. Same thing with people always talk about a thing called an offer and compromise, where you go to the IRS and you try and negotiate your tax debt down. But the IRS at a minimum, if you owe, they can only accept an offer that at a minimum is 20% of the tax you owe. So you owe $1 million. It has to be at least $200,000 that you pay them. And the IRS isn't stupid. They're going to function like any other creditor and look at your age, income, the other, not just your crypto assets, but every other asset you have. They're going to look at how creditworthy you are and how much they think they're actually likely to recover the money if they just put a lien on your assets and wait you out. Yeah. So it's not like you can just say, hey, I've got a couple $1 million of real estate here, and I've got $1 million in my 401k, but I lost all my crypto money, so I don't want to pay tax on that. They're not going to look at that way. They're going to look at every bit of what you own and how much you make.
Yeah, absolutely. So, I think that's a really good point to bring up of, hedging that bet of saying, hey, look, there is a big potential upside, but because of the current nature of this, making sure that you literally have that money in the bank, for that. And I think also what you said of making sure it's in, dump it in a Chase, something with FDIC insurance, doing that is a good factor, because just like we saw with, I believe it was it the judge in the Celsius case stated that the assets were the property of Celsius, which is absolutely bonkers to me. But again, it goes to show that, when you click agree to some of these terms of service out there, read the darn things. They're painful. I'm the one that gets to read the tax legislation. I just read the entirety of the Secure Act 2.0 omnibus update, and yeah, it's painful, but you know what? Informed decision making is the best kind to do. And if they state it, granted, FTX is clearly in violation of their terms of service. We'll see what the judge does in that. But Celsius, pretty clear to a point.
Yeah.
And
they said it in there. I mean, nobody read it.
Deposited to our system become property of Celsius Network, and at that point, you're kind of up a creek with that stuff. So, making sure that you understand I think another big thing to understand for people is not only understanding, it is inherently, besides just the risk of cryptocurrencies values fluctuating, there's a lot of other things too. It's a very, kind of, for lack of a better term, and I hate that this keeps getting used, but it is kind of the wild, wild west. People are constantly expanding and moving farther out there and getting new and interesting things. Whether or not they work out, that's the risk factor of the investment. But also, these people are, kind of just mavericks, for lack of a better term. There's good and bad with that. If you've ever seen the movie Tombstone, pick your character on cryptocurrencies. You might have good luck, or you might not.
And that's what we run into a ton, because crypto investors, I think just the nature of people who are interested in it, they're not risk averse at all. They are fine losing the entirety of their investment. They're fine taking bigger gambles. They say, well, I put it in there. If it goes to zero, I'm good. Which that's fine. If that's your investment strategy, more power to you. But they completely forget about the tax side. It's one that strategy is fine so long as if you have you're generating taxable income, you're at least setting enough aside to not to cover that part.
Yeah. So
then otherwise you could drive yourself literally to bankruptcy in some extreme cases, obviously, but it can happen.
Yeah, so it's like one of those things. Not only do you lose the whole nut in, your values zeroing out, but then also you might owe the IRS a huge tax. So it's like, adding insult to injury and pouring salt all over those wounds is a real risk there. Now, from that perspective, I think that's a really good point to make of, making sure you understand that, if you have upside in this and you have exchange and you have all this, reportable income, because they aren't like kind exchanges after 2017 or 2018, that's a big thing, making sure you scale back, put money in an actual bank to do that. But what are some other things, besides that one tidbit that you think would also be good for investors to be aware of when it comes to, taxation in crypto?
Yeah. So again, especially for the people who are just trading right now, the wash sale rule doesn't exist. So if you've got big losses in traditional securities, if you buy something that's identical, or I think they say, I can't remember the exact term, but like functionally identical or something that's like very, very similar, they disallow the loss. At least right now, you can tax loss harvest and book those losses either to use this year or future years. And it's just basically the exchange fees that you're losing, whatever costs are to do both sides of that transaction, that's it. So that's a really, really easy one. For the handful of people out there who have business income, so mining income, node income, and you don't hear much about play to earn right now, because all those games like they all have a very inflationary problem with their tokens. So they all seem to go up and then crash down about 90 to 99%. But if you were playing that game literally as a profession, and that gets classified as business income, any business income, once you're making over like 40 or 50 grand profit, it makes a lot of sense to have that running through an entity, usually an LLC, and having it taxed as generally an S corp or occasionally a C corp. But either one of those setups is going to save you the self-employment tax, which is the employer and employee has of Social Security and Medicare. So if you're running a mining operation, you make $100K profit in it, and it's just in your personal name, you're going to pay Social Security and Medicare on all of that, which is 15.3%. So you lose 15 grand before you even pay income tax. So for that bucket of income, which is a little bit more niche, but it's still not an inconsequential part of the market, that's usually not a no-brainer, but there's a lot of benefits to that.
So running cryptocurrency through some type of entity now, are there any kind of like function tests of that? I mean, anyone can kind of go out and set up a single member LLC, but is there any treatment of is there any kind of IRS examination of saying, okay, well, this functionally is just you, we're not going to offer that? Is there any type of thing where you have to meet a certain standard or procedure of making sure that you properly contribute capital to it, have separate accounting? What are some things to look out for?
I mean, you would run it the same way you would any other business where you set up an LLC or a corporation. You don't want to have it to where you're commingling the funds. You don't want to have it to where you want to have a good operating agreement. You want to have everything lined up to where it's got its own bank account, its own credit card, to where it is truly, as much as is reasonably possible, distinct from you as a person. And then when you basically, like you said, if you just go and register an LLC with the state corporation commission, that's all you do with it, the IRS is very likely to say, okay, cool, you set up this entity, but operationally and in practice, it's just you still. So you want to do whatever you can to you get the tax ID for it, bank accounts, everything to get some degree of like segregation from you as a person.
Yeah, and another good pointer that I got from an attorney that I've known for a long time is specifically with that. Again, like you said, not just going to your state board and saying, "Hey, I'm an LLC now." Okay, great. You need to have an operating agreement. You need to make sure there's a clear delineation of some type of capital contribution to this. And again, with what I'm saying, we're not giving tax advice. Trust but verify. Again, to make sure this stuff. But also, what he mentioned is that if you get an operating agreement, that is an agreement you're signing and agreeing to abide by what it's stipulating for that. So if that operating agreement is saying, hey, we will have quarterly, meetings with, attached minutes, or we will have, certain voting standards and you're not recording, voting, if it's a single member LLC and you have contradictory language, anyone can. Google's great. It's a blessing and a curse. You can go on there and find a free operating agreement that who knows who drafted. But if you go in front of the IRS and they say, okay, great, this is that, you get audited. Okay, great. Let's see the documents for your business. Show us the minutes that it states here which should be recorded from any activities of the voting members. What? They can pierce right through that and say, okay, well now, yeah, you were functioning correctly as this. You didn't abide by any of the covenants you agreed to in this. And then they just pierce that veil and you could potentially have other tax issues with that. So, the entity thing, and I see this a lot from my clients, is that I always make sure to say, hey, if you're going to run anything through an LLC, any investment thing, yes, you can get resources online, but make sure you understand what you're agreeing to, and paying the couple $100 for an attorney or a qualified CPA or someone to do that type of document drafting for you, so you understand what your obligations are to enjoy either the operational benefit or the tax benefit, is cheap insurance.
And it should be an attorney, just by the way, because there's a lot of CPAs out there who will try to do it. And we're more trained in that area than the average like lay person, but we're still not attorneys. We're still, when it comes to the law, we're still lay people.
Yeah.
And a CPA is more than likely going to charge you very close to what an attorney would for about half the quality of work.
Yeah,
so
exactly. And a lot
I don't like CPAs who do it, and I tell people not to use. So
yeah, and again, a lot of these, and most people say, oh, well, they all kind of look the same. Yeah, a lot of them are boilerplate. But at the same time, you're paying for that experience of that person behind it, to where you go, hey, I don't understand exactly what this is. And they go, oh yeah, it's, here's what that kind of means. Here's how it applies to you. Here's what you need to make sure. Here's the records you need to keep, to make sure that this thing stays in good standings. Again, it's not just paying your $150, $200 to your state every year. There's more than that. There's record keeping requirements. There's, other tax benefits that you could potentially enjoy, like home office stuff, all sorts of different write-offs you can get from running a business. But if you have enough revenue, I mean, the juice has to be worth the squeeze. If you're investing $10,000 in crypto, going through the hassle and headache to run it through an LLC or a C Corp or something is not there. But I would say, you probably start getting into the $50,000, $75,000, $100,000 range of investment. You tell me, when do you think maybe kind of a good inflection point for people to look at that personally to say, hey, doing this stuff through an entity might be beneficial? And it probably varies depending on what state you live in too, with state income tax and things like that.
It really only, without getting into, I'm sure there's some really complicated things you can do with like offshore trusts and things where you're talking in the millions of dollars. There's some really complicated strategies you can get involved in. But for the average person, running it through an entity doesn't make much sense unless you've got, for crypto, and unless you're just looking for an additional layer of legal protection, or if the crypto income you have is classified as business income and the entity is a way for us to save and bypass self-employment tax and save that 15.3%. So most of the clients we have where we're setting them up in entities, it's usually because they've got a bunch of mining is hard to be profitable just with electricity prices, but it's people who are doing very, very well, typically in node income, but occasionally a play to earn game. Those are the ones where it's just an immediate tax savings.
Yeah, exactly. And also, from that perspective of it, will kind of move on from entities in a second. But again, I really want to hammer on people, understand what you're doing with those things, because they can get you into a considerable amount of trouble. And also from a liability standpoint perspective, the United States with liability protections in LLCs is it's bigger than Baskin Robbins. It's 50 different flavors, and the District of Columbia. They view their liability protections for those differently. At least here in the state of Florida Supreme Court generally agrees that liability protections for single member LLCs are moot. They pass through to the individual owner. They have to have at least a multi-member partnership in order for the liability protections to really kick in. And there's, again, varying shades of gray with that statement, but that's a general statement. Some states, yeah, you have an LLC, so long as it's in good standing and abides by its operating agreement, you have a pretty robust liability protection. But again, if you just want an LLC in because it says limited liability, it may not limit your liability at all.
Yeah. Yeah. And especially if you're not, depending on the state. And again, like you said, 51 different variations of what it could look like, but especially if you're just sort of a little laissez-faire with the way that you're operating the LLC, you're just opening yourself up to even more liability.
Yeah. There's, it's easy to say, oh, LLC is easy. There's the reasons that attorneys spend 7-8 years in college to specifically focus on corporate law. It is not that simple. Okay, so we've kind of covered the taxation issues of the run-ups, the gains, making sure that you kind of have some literally money in the bank to pay for those. Depending on the type of income, if you're generating some type of what can be business income, which would be more of like an activity, like staking or and node income. How about things like mining activity? What about cryptocurrency generated from the act of mining? Would that be business income?
Mining income is business income, and that's one of the few things the IRS has actually issued explicit guidance on. They've said that mining income is business income. So our treatment and our stance on how node income, they haven't specifically addressed nodes at all. We're extrapolating that based on the similarity of running a node validator to mining.
Okay.
So mining income is the only one we know explicitly 100% for sure that's business income.
Yeah, exactly. So if you have something that is going to be, again, income, a bit like that would be like activity-based income, not trading-based income, looking at the entities as a potential way to block having to pay that 15%, Social Security and Medicare tax. Past that, what would be kind of a third avenue that people can really look at as far as, what they need to understand in the current market, and maybe something a little bit going forward? How can people kind of set themselves up for success, or at least, have a good idea of what direction things are going?
Yeah. So the other thing we talked about a lot, especially during the bear market, and this one's counterintuitive, and you also don't have this level of control in every project, but it's actually accelerating your income. Because for most tax things, we're always trying to defer your income as much as humanly possible. We don't want to pay the tax now. We want to defer it. We want to have the utility of that money, time value of money, all those reasons. But right now, depending on the client, there can be some long-term, some really significant tax savings just to taking the hit now. So you can add that with some degree to trading income. You decide when you're executing these trades. So if you have realized gains from something you held before this bear market, or you just got lucky, normally you'd say, okay, well, I don't want to execute that and generate a taxable event. But when you look at, okay, well, my overall income this year is down 50% because the market's in the toilet, and you look at the tax rate you're paying because of that, it can make a lot of sense to go ahead and to execute that trade, take the income now, because if you compare it to if you did that exact same trade, if nothing changed, but your income went up next year, you're paying a lot more in tax. And trading's the easy example. There are some examples with in tax, there's this thing called dominion and control, which is basically the idea of when you have complete and unfettered access and control of the asset, that's when you claim it as income. Some projects, there's a little bit of fuzziness as to exactly when you get dominion and control, and without getting too in the weeds, you've got control when you claim the income. So normally, again, you push that off as long as you can. In this case, it can make a lot of sense to go ahead and, like certain node projects, you can know when you can claim the income when you want. Take the hit now when the token is worth 20% of it was last year, and you have to claim that income, but at a much lower level than you would have last year. That also starts your holding period for capital gains purposes. Mm-hmm. So without getting too in the weeds, we've run through examples with some of these node projects to where if you sell it for, I think what the example we used was like $600,000. You sell your tokens for $600,000, but there's a difference as to when you claim the income. It can cut your tax bill in half, because you're moving it from an ordinary income bucket to a long-term capital gains bucket. And again, it's hard to run through without spending like 10 minutes on it. But again, it can actually make sense to go ahead, take the hit now. But that's a little more situation specific, and you should talk to your CPA about those typically.
Yeah, and that's a kind of a big running tenet, at least in a lot of some of the tax planning stuff that we do here as well, with things like Roth conversions. Especially illustrating the point of depressed values. We saw a lot of that back in, let's say, 06, 07, where we had people might have had $500,000, $750,000 of real estate holdings in their retirement plans, and it tanks. They don't necessarily want to sell because it's a long-term play anyway, but saying, hey, real estate is anything, but it typically will always appreciate over time if you just hold it long enough. And we had a lot of people doing Roth conversions back then, and have reaped immense benefits from it. Yeah. And also, if you are doing this stuff through an IRA, again, to that point of hey, everything we've talked about today is if you did this to an IRA, you have to worry about virtually 0% of that, with the exception of the fact that you're investing in something highly risky within your retirement plan, which has its own other canon of things to look at, with just saying, hey, I'm doing something that's supposed to benefit me when I can no longer work. Maybe running the roulette wheel of crypto isn't always the wisest thing to do all of it, but again, having a portion of it, and that's where diversity is key in everything you do. Having all of your eggs in one basket, I don't think you'll find many, well, I hope you wouldn't find any financial planners or CPAs to say, yes, this is a great idea for you to go all in, no backup plan, send it. Yeah. So, with that said, it can also lead in, with market. I think what you're kind of getting at is market awareness of realized income with that. Saying, hey, when am I going to actually claim this income? And that same principle can apply to things like Roth conversions if you're investing in crypto as well. Because the nice thing with crypto is that because it is volatile, you can kind of follow it to a point and say, okay, great, it's to a point where I want to claim this. And, again, with that realized trade or that Roth conversion, it is a snapshot in time of its value. It could, again, it could continue to drop further and maybe saying, oh, well, if I'd waited a little bit longer, or it could immediately, just like we've seen with, Elon tweeting about Dogecoin. It's, stuff can get, run up in a day just by certain talking heads talking about this stuff. So, having that flexibility on, when you actually are going to realize that income and get that, dominion and control is big in this space. And I think that's something that people probably don't look at enough. I would say, just from what you're talking about, it makes a lot of sense to me, but I would think that is probably something that gets missed more often than times than it gets caught. Just like the second point, or just like the first point we made of saying, hey, if you're doing this, make sure that you are, converting stuff back to fiat. So that way, when you do have to pay taxes, the IRS is going to look at your crypto wallet and say, cool story, bro. They're going to want, US dollars when it comes to paying them. And I have yet to meet an IRS agent with much of a sense of humor. So
me neither.
Making sure that, you can, adequately engage with these people is, again, very important. We're kind of running up on an hour, but again, I could prattle on about this stuff. But before we get too far in the weeds, any other kind of tidbits you think of things that you think might be helpful to people investing in cryptocurrency, notwithstanding the inherently very volatile and risky nature of it from a tax standpoint? What are some other good best practices?
I mean, it gets a little too granular. It's like a 40 different little topics that you could talk about. But the other main thing, I guess, is just keeping track of what you're doing. That's true if you run a business, if you have any sort of investment portfolio. But I think because crypto, there's a slight additional challenge, because especially if you're not just doing it all on Coinbase or Binance or one exchange, you're responsible for your own tracking and reporting. So making sure that you're tracking this stuff throughout the year to see what your gains are, what you need to set aside, just doing some sort of even very rudimentary back of the envelope just calculations of what you're looking at, because then that's going to inform your investment strategy going forward and how much liquidity you have and all those things. And I think we joke about being magic internet money, and I think that's fine if you're just you're fine losing everything, but we take that to an extreme of just acting like there's no consequences if we lose it, and there's at the very least a tax consequence. So making sure you've got some pulse on how you're doing this year, what the tax liability will look like, that will save you from the examples we talked about earlier of just getting absolutely creamed. And you'll probably have a better just general ROI if you're really monitoring what's going on.
Yeah, and that's a good point, because you may very well know, hey, I have X, Y, and Z, but when it comes to do your taxes, people have a tendency to get a little bit tunnel vision. So you say, okay, like let's say my main account is Binance, but you forgot that you were involved in a few projects that aren't traded on a blockchain. I can't remember one of them that I have a client that's invested in. It's like you have to go directly through their portal. It's not like on a particular like traded blockchain. So like if you had some stuff in a different project, and you're saying, okay, great, I've reconciled everything, here's my Binance statement, because not all of these coins are listed on every single exchange, which again I think is a detriment, that maybe classifying this stuff as a security would have a benefit to where it's going to kind of weed out the smaller people, which I don't like from the small business background I have in my family. Like I don't like to see government regulation kind of clear out, smaller players, but I think you have to look at it as, the bigger benefit to the investors as a whole. Having, bigger players that are more apt to be able to engage with that and consolidate where people are doing this would be a good thing to a point.
Right. And regulation's going to be responsible for some of that consolidation. Some of the consolidation, we're just going to see it just from general market conditions. Like the idea of crypto initially is decentralization and this pseudo anarchist type thing, but we're already seeing that. I mean, it's Web3. It's the next iteration of IT, and we're already seeing where people who have really cool ideas but are undercapitalized. It's the same as if I was going up, I had some cool idea for a CRM or something, I decided to go against Salesforce. Like I might have a great idea and that's unique, but they're going to be able to clone it and improve it. There's no way I win against that. So I think some of that we're already seeing, where it's just the little guys can't keep up, because I'm not a dev, but at least my understanding is that programming for blockchain is especially time consuming and expensive, is at least the way I'm understanding it. So these little guys are already, good or bad, kind of going by the wayside.
Yeah, I mean, you had, even some bigger ones getting consolidated. Like there was the consolidation of ErisX and, different other bigger players too. And now, especially with the void that is being left in the market by people like FTX, Celsius, and all these other people, I think the market is kind of doing it itself. Granted,
and who's going to go to a third-rate exchange after FTX and Voyager and Celsius collapse? Like, who on earth is going to go to some, ranked 200 exchange, given the risk of the top 10 going bankrupt?
I think it's going to be a big benefit to people like Coinbase, Kraken, Binance.
Fidelity's getting into it now.
Which one is the one that the Winklevoss twins own? Gemini?
Gemini, I believe.
And didn't they get in trouble not too long ago? Didn't they have some issues?
I saw some headline, and they were I haven't dug deep into that one, but yeah, there absolutely was something that popped up recently with them.
Yeah. And one thing I'll leave that I tell we kind of bring this in for a landing. One thing I will tell anyone that invests in cryptocurrency, and I've said this before there were these huge issues, is that security is big in this stuff. Understanding what things like offline cold storage and what hardware options are out there for you, keeping your tokens and projects and things like that on an active hot exchange is just begging for issues to happen for you. It's, kind of like, putting your money on your front porch and just putting a blanket over it. Not too many people are going to come lift that blanket up and steal your money, but the ability for it to happen is there. If you have a safe inside, why not just stick it in the safe? And it's really not that hard to understand. So, besides the underlying more complicated tax stuff, some small best practice housekeeping things like understanding where your cryptos are at, what you hold, everything like that, and also the basics of how to do it are very important for people.
And if it sounds too good to be true, it is. Being aware of these scams. I had a call a couple months ago where the adult son had supposedly made $500,000 in like a month with somebody who messaged him texted him accidentally, and they became air quotes accidentally, and within 5 minutes I'm like, you don't have to worry about the taxes, you're got scammed, you need to try and get your money out. And sure enough, they lost like a couple $100,000. So
oh wow,
yeah, I mean it's pretty bad. So just general, like exactly what you're saying, just general common sense practices go a long way.
Yeah, and if you don't understand that, talk to people that do. And I would encourage you, talk to people that understand it. And if they're trying to sell you something, talk to someone else that just wants to educate you.
Please.
Yeah, there's the great thing about the information age, and especially with stuff like you said, like Web3, is information availability it's out there. It's not that hard to find. Just make sure you're getting it from somewhere that is, not trying to turn on be like X, Y, and Z, and then buy this token. Talk to people that, are willing to give you the information and share their experience and aren't trying to sell you something. And, you'll get at least a good foundation. With that said, Micah, let's bring it in for a landing. Anything else that you want to leave people with? If people, have cryptocurrency issues, because, besides like my general accountants that I refer people to, you're the first one that specializes in this stuff. So I'd love for you to give
There's not a lot of us. Yeah, so if anyone is involved in crypto and wants to reach out, then go to cryptotaxcpa.com. That's our website for crypto investors. And we typically are working with people who are making six figures or more in crypto, just the way our pricing structure works, our service offering. So if you're just sort of a more, not even beginning investor, you're just not throwing that much money into crypto, we also have a book that the ebook version is free on Amazon. It's called Decrypting Crypto Taxes. The way we set that up is that every chapter is basically a frequently asked question we got of, is this taxable? How is it taxed? What do I do when this happens? So for the people who have a couple grand in crypto and don't really know how fill in the blank should be taxed, that's a reasonably good resource out there just to give some baseline understanding of all the stuff that they're going to be dealing with.
Absolutely. All right, great. Well, Mike, I really do appreciate your time today. Again, that's the one thing that you can't necessarily quantify a price on, because it's the one finite commodity we all have. So I do appreciate you being with us today. If anyone has any questions, he gave his contact information. I can also be reached at 727-754-9954 for Advanta IRA for any questions on crypto investing with an IRA. Thanks for joining us today, and have a great rest of your day.
Thank you for tuning in to the Alternative Investing Advantage podcast. Tune in next week for more investing tips and strategies.
Want to hear more episodes of the Alternative Investing Advantage? Search podcast at advantaira.com and subscribe.